active segment of the Indian fixed income security market is your government bonds. Banks and financial institutions invest in government bond market for strategic SLR requirement and long-term stable and secure returns. So, in government bonds, who are the major contributors? Banks and financial institutions. Why do they invest? Just for the SLR requirement and long-term stable and secure return. Okay, government bond usually give you secure return. Reserve Bank of India is one of the largest holder of government bond, which help them to manage the market liquidity. I have already told you, RBI manage market liquidity through buying and selling of government G-SECs, government. RBI is the depository of G-SEC, that is government securities. G-SEC is nothing but government bonds, and also the merchant banker and transfer agent. I will tell you what is primary dealer, what is merchant banker and transfer agent. Okay, banker and primary dealer are the same. Merchant banker is nothing but there are some merchant bankers which are already nominated by RBI. Previously, RBI is the one who used to manage the government bonds G-SECs, which are issued by the government of India. Okay, now they have RBI, even though they are the depository, they have given this responsibility after 1995 to certain big entities like Goldman Sachs, RBI guilds, ICICI Securities, and some of the banks have been nominated to perform the function of the depository along with the RBI. They are called as the merchant banker. Their main job is to buy and sell the G-SECs in order to help the government to perform their whatever is the expenses which they want to make, fiscal policy they want to make, they can make through this buying and selling of the G-SEC. So that is known as primary dealers or merchant banker, and transfer agent. They are all the means the same. Okay. Now let us understand types of bond instruments. First one is the treasury bills. I have already told you. Then cash management bills, dated G-SECs. Dated G-SECs is nothing but this is the largest component of government SEC with maturity from 1 year to 40 years, right? It is issued on the basis of issue calendar issued by the RBI. Fixed rate bonds will have fixed coupon but issued biannually. Floating rate bonds was introduced in 1995. Now coming to the zero coupon bonds. See, there are, other than G-SECs and all, you have got something called a zero coupon bond. Then there is something called as capital index bond, which was introduced in 1997, where the principal amount, that is 100 rupees if it is there, that will be always indexed to the inflation. As the inflation rises, the principal amount will also rise. As the inflation decreases, the principal amount, the value of the principal amount will decrease. Inflation index bond have their principal indexed to world price index. We have already discussed in detail bonds with call and put option. Now, special securities are nothing but certain types of bonds which are issued as a compensation by the central government in lieu of cash subsidies which they are supposed to give to certain entity like Food Corporation of India, Indian Oil Corporation, fertilizer companies, etc. You know what? See, fertilizer company, they manufacture fertilizer, but the cost of the fertilizers, which at the rate at which they are selling, is far less than the rate at which it is manufactured. So, in order to ensure that the fertilizer company does not lose out, government support these fertilizer companies because fertilizer is required by the farmers. Similarly, for Food Corporation of India holds lots of grains and others. They are the largest holders of the granary. So, in order and the grains and all which they are going to sell at fair price shop is far less than the market price. So, how are they compensated? The government has to pay them cash in lieu of the less price which they are selling in the open markets. This applies to Indian Oil Corporation also. So all these cash subsidies, sometimes the government may not be able to pay these cash subsidies. In that case, they are going to issue special bonds. These special bonds are called as special security. However, these special security issued are not eligible for SLR, and hence they have higher yields. Now, there is another platform called as separate trading of registered interest and principal of securities. Don't get confused by this long definition. It is they are going to trade the principal amount of the coupon of the bond and the interest part of the bond separately in a open market. That is known as stripes. Okay. See, suppose if you have a 230 dated bond with coupon rate of 5%, then the principal amount becomes principal strip. That is, the principal amount will be traded separately in the market. Then the coupon cash flow becomes a coupon strip. That is, the coupon cash flow which you are going to receive will be traded separately in the market. Other than this, there will be sovereign gold bonds, which each one of us knows nowadays. Sovereign gold bonds have been sold in even the broker platform like Zero, the 5paisa everywhere. And now a new sovereign gold bond is presently open. See, sovereign gold bond is usually linked to commodity prices of the gold. The denomination of the sovereign gold bond is 1 gram and multiples thereof, and they pay a fixed coupon per annum biannually. As of now, I think it is 2.35% if I am not wrong. So annual payment of 2.35%, but it is paid biannually, twice a year. The redeemed value of the 1 gram of gold. Suppose if you have invested in 1 gram of sovereign gold bond, the redeemed at the time of redemption, the price will be calculated based on the last three prices published by the Indian Bullion, and they take the average of that, and that price you are going to get. There are something called as taxable bonds. You know, See, taxable bonds issued at par of 1000 and multiples with there will be no maximum investment limit. Whatever interest you receive are taxable. This is basically for retail investors like us. State development loans, I have already told. These are the bonds issued by the state government. They also do semi-annual paying. But the state development banks, any bonds issued by the state development banks, if it is, the lending is done by the banks, it is eligible for the SLR and borrowing under liquidity adjustment facility of the RBI. I will explain SLR and liquidity adjustment facility in the subsequent slides. Uday bonds issued for state discoms financial support are not